This stock, in my opinion, is going to have a record 2021. It already has 7x'd in the last 12 months since it first IPO'd, and this stock is doing extremely well. I think there's so much upside because everything is aligning for the stock to have a great year. Yeah, despite AMC having that record-breaking weekend with Godzilla vs. Kong, this analyst came out and just wrecked them. He says that the stock's worth next to nothing. Pretty ridiculous, but let's get right into it. Well, welcome back to my show, guys. We go live every day at 8:30 a.m. Eastern Time. We talk about the stock market. So if you're new here, welcome to my show. Make sure to subscribe to my channel so you can be notified when we post new videos. AMC the other day came out and they had some news about issuing new shares, 500 million new shares that they have authorized to be able to issue. And also they had a record-breaking weekend with Godzilla vs. Kong. Things looked really, really good. They did much better than people were expecting in this opening weekend because there's only 50% capacity, like theaters right now. And despite this, only half movie theaters being open, having limited capacity, they still had a record-breaking weekend for Godzilla vs. Kong. Record-breaking numbers, the box office. There's just a much bigger turnout than people expected. And now an analyst, even with this, came out and reiterated his $1 price target for AMC. And I think this is a joke because even at the height of the pandemic, when everything was closed, the stock was still above $1 per share. And now the worst is over, in my opinion. Like, things are getting better and movie theaters are starting to open back up again. There's obviously demand for people to want to go. Like you saw the other day, right? People turned up at the movie theater for Godzilla vs. Kong a lot more than people were actually expecting. So it makes no sense to me, but his reasoning behind this, which I disagree with, his reasoning behind this, he says, is that the fundamentals of the exhibition industry have declined. AMC's competitive position, in our view, has not improved. Its enterprise value has almost doubled, while its closest competitor's value has declined. They say the industry should bounce back, and Godzilla vs. Kong results were encouraging, but we do not see the results reaching pre-pandemic levels in the next few years. He said, assuming the pandemic value, which may be generous, implies little equity value bearing successful financial engineering. Dilution is something we care about, but I say we are formally asking approval of our shareholders, another 500 million new shares the company could issue if it wishes. So basically he's saying everything's already priced into this stock, and so he reiterated a $1 price target. In my opinion, that makes no sense because things are starting to open back up again. AMC acquired a lot of small movie theaters during the pandemic. They had a lot of debt on their balance sheet, but during the last couple of months, they've raised a lot of money through stock offerings. They've raised money, been able to pay down the debt. Now, as the economy starts to open back up again, things are looking on the up for AMC. They had record-breaking numbers for Godzilla vs. Kong. Movie theaters are starting to open back up all across the country. They're able to pay down their debt. And on top of all this, a lot of movie theaters like Warner Brothers, they actually came out and said that in 2022, they're going to actually be releasing the major movies strictly in movie theaters first. They're not going to do that dual process where they release it on streaming and in theaters at the same time. They said they're going to stick to the way they used to do it for the major titles, and the major names they're going to release strictly in movie theaters at first. And obviously there's demand for people going to movie theaters. So this $1 price target, in my opinion, is a joke. It makes no sense. Like, at least give it, in my opinion, it's not worth $1 per share. Not at all. With everything going on, reopening, people wanting to get out of their houses, go to movie theaters, vaccines getting distributed, I think movie theaters are going to do extremely well over the next couple months. I think there's going to be a surge as more people get vaccinated. I think we're going to continue to see numbers rise in movie theaters. And I think there's really no way that AMC is $1 per share, should be worth $1 per share. Like, I could get that a lot of the upside's already been factored in. I could see it, not going to $20 a share, but at the current price it's at, right around $10 a share, $10 a share, I would say, even at $12 a share, doesn't matter. I would say that a lot of the upside moving forward has been priced into that, not at $1 per share. I could easily see this, at a $4 billion market cap. I think there's still upside here in the long term, but even if anything, a neutral rating, if anything, I would say, especially with Wall Street Bets, all the people behind this stock, I don't see it selling off to $1. I think this was ridiculous, but I don't, I'm not on the other side of it where I see this going to $30 a share anytime soon, but definitely not to $1. Next up is Nano Dimension. So Nano Dimension just announced some pretty big changes in terms of the company executives and the board members. And they just announced the other day that someone named Zivi Nandivi has been appointed president of Nano Dimension. Previously announced a couple weeks ago, it was announced that the CEO of Nano Dimension will be appointed the chairman of the board. And so that's already been said. But now, Mr. Nadevi, who will be appointed who has been appointed president of Nano Dimensions, he's had a lot of success in the past. And I think this move by the company is pretty good. They made a lot of different changes to their board, to the C-level executives. They also recently, in addition to him, picked a new product chief and head of strategic M&A. So they made a lot of big changes, but this guy in particular, he helped bring a company called Kellstrom. He was CEO of that, and he grew the company from $8 million in revenue to $330 million in revenue during a 5-year period, including 9 different acquisitions. He also he managed supply chain. He, was in the supply chain and advanced data management industry with this company. He also was the CEO of Luminous, which was a world-leading developer of energy-based technologies. He was responsible directly for 1,000 employees in 5 continents. So he has a lot of experience, and I think this move is very exciting because Nano Dimension is on the verge of really exploding. The industry that they're in, the additive manufacturing, 3D printing industry, is on the verge of really exploding over the next couple of years. Nano Dimension, they are able to 3D print products and they're in an industry that is rapidly growing, that is actually needed. They 3D print products for industries such as like aerospace and technology, not semiconductors, but technology. And they 3D print for a lot of different industries. They've had to overcome a lot of different challenges with their Dragonfly 3D printing system and that technology. They've overcome a lot of that. While the revenue wasn't so high in 2020, I think this new position that they appointed him to is going to be really, really important. Nano Dimension, they are, they do work for defense, aerospace, autonomous vehicles, robotics, biotech, and with his experience growing a company from $8 million in revenue to $330 million in revenue in just a couple of years, I think this is a great move by them. Also, on top of this, I think with their new product chief and head of strategic management of M&A, both of these people have a lot of experience, decades of experience leading technology companies. So I think combining all 3 of these new picks for executives, board members, I think it sets them up really well for the future and moving forward, especially with 3D printing industry set to grow at like 26% year over year for the next couple of years, for at least the next 4 to 5 years. So we'll see what happens here. Their Dragonfly 3D printing system has been growing very rapidly, looking to continue to grow their revenue pretty dramatically from 2020. And I think they're positioned very well. ARK Invest loves the company. Now they have new people leading the company. And on top of all this, the industry is growing very, very quickly. Speaking of industries that are growing very quickly, Fubo TV, they are a streaming service that has also been trying to start looking into integrating sports betting and online gambling with streaming services. And they just had a major announcement in a pretty big market, which I think could lead to a lot of revenue down the road. And they announced just recently that they signed an agreement with Marquee Sports Network, and they're going to be now, with this agreement, they now will bring Chicago Cubs games coverage on their platform. So right now, Fubo TV has tens of thousands of different sports, live sporting events annually that stream on its platform. Many of them are in 4K. But with this new partnership, they're going to have access to all marquee programming, including all non-nationally televised regular season Chicago Cub games, pre-game and post-game shows, exclusive content, original programming, and much more. So even though, this is just a regional sports network, it will be a pretty big deal for Fubo TV because Chicago is in a market, Illinois is a state where they have legalized sports betting. They legalized sports betting in 2020. And that's a really big deal because Fubo TV has been looking to grow and expand their business by leveraging sports betting and sports gambling and integrating that with streaming service. So they're already making moves here, and they're looking to hire about 100 new employees in Chicago for new sports gambling division that they're going to be setting up. This is really because Illinois is a big market in terms of online sports gambling, and having now all of this content for Chicago Cubs and this regional sports network with Marquee, this is a big deal. This is going to really allow them to start their process of integrating online sports gambling into their platform, and that's how you're going to see this company really explode in the future. That's where, if you're betting on Fubo TV being a really big company, I would think it has a lot to do with online sports gambling and what is going on there. So right now, with this, in the Chicago area, you'll be able to get all this regional sports network. It covers a lot of different sports in the Chicago area, and now you'll be able to get a lot of different exclusive content on Fubo TV for the Chicago Cubs. And in my opinion, I think this is going to open the door to a lot of different aspects of integrating sports betting and online sports gambling into the platform. Not to mention with the 2021 baseball season recently kicking off, and that's going to help as well. So it's going to bring more traction to Fubo TV, and it's going to give people an option who have been looking to switch away from cable and TV to now go to streaming, and they're going to be able to cord cut and go to Fubo TV. Speaking of big announcements though, NIO. I don't know if you saw with NIO. Did you read up on NIO the other day? Yeah, so NIO, they just announced that they officially delivered their 100,000th vehicle from their manufacturing plant. This is a production milestone, a pretty big one, 6 figures in terms of vehicles delivered, and it just took them a couple of years to do this. NIO said just the other day that its 100,000th vehicle was officially off the production line, and now this happened less than 3 years from getting their first vehicle off that line, so that's a pretty fast rate of growth. Most of their vehicles delivered have come just within the last couple of months. Last month alone, last quarter, first quarter 2021, they delivered close to a little over 20,000 vehicles. So just about a fifth of all the vehicles that have been produced at this factory have come in the last quarter. So they're really ramping production up. But it was pretty, their 100,000th vehicle was actually an ES8 model, I believe, and that was also the first vehicle that was off their production line. So it makes sense, it was ironic that it was the first and 100,000th vehicle off that production line. Currently, they have the ES8, ES6, and E6 models. They just just the other day, I did a video on this, they actually the other day got the ET7, which is a sedan. They got that model, a production model, off the line, so now they're continuing to work on that. We're not going to see that delivered for a little while. But that's big news. 100,000 vehicles, 20,000 in the last quarter. That's a pretty big milestone in my opinion, and they're really ramping up production very, very quickly. Average price for all of their vehicles, that they've sold so far has been right around $65,000. So that really positions them in the high end, the luxury market, pretty comfortably in the luxury market. And the chairman and CEO, William Li, their founder, he said in a media event the other day that the company commands 50% of the high-end EV market in China, which is defined as EVs priced over 350,000 yuan. Average price for NIO is, like I said, $65,000 or around 428,000 yuan. And William Li says that he thinks 1 million vehicles sold in terms of volume is going to happen very, very quickly. He thinks that should happen very, very quickly. Right now, they've had a little bit of issues just in terms of having to slow down production because of chip shortages around the world and global chip shortages. So their capacity in their factory is 10,000 vehicles a month. They said they're going to have to cut that back a little bit to 7,500, trim that down at least for this month, maybe next month, just because of the chip shortage going on. They had to shut down their factory actually for a couple of days back in March. So hopefully they don't have to do that again, but they're going to trim down their production. So it's going to be closer to that 7,500 vehicles per month. And that's because of the chip shortage, which really unfortunately, there's nothing they can do about that. But either way, that is big news with total number of vehicles they've had delivered so far. 100,000 is a big milestone. Speaking of electric vehicle companies, the biggest one out there, Tesla, according to Morgan Stanley and analysts, they're saying not owning Tesla stock is actually a greater risk than owning Tesla stock. They said especially ahead of this massive infrastructure package that's supposed to be passed and that has been proposed by Joe Biden already. They're saying that it's a massive risk not to own Tesla because there's a lot of upside, especially with Biden's proposed $2 trillion infrastructure bill, which is going to be spending $174 billion for the electric vehicle sector alone. And if there's going to be money, hundreds of billions of dollars poured into the electric vehicle industry from the government, you better bet that Tesla, which is the biggest electric vehicle company, is going to benefit from that. So I don't know. Did you hear the other day? You saw the package, right? With Tesla. With Joe Biden and the infrastructure bill. It talks about having 500,000 EV charging stations, talks about spending money to upgrade the electric grid, benefit stocks like STPK, STEM Inc., and also with just electric vehicles in general, electric buses. So, yeah. So right now, this bill, if it were to pass, would have a lot of benefits for Tesla. Analysts at Morgan Stanley, they said in a note the other day that this bill will increase Tesla's advantage over legacy players and new entrants, just going to give them a bigger advantage overall, really going to make them separate themselves even more than they already are from other companies that are in just the auto manufacturing space, whether they're EVs or combustion engine, doesn't really matter. They said either way, these policies are going to accelerate Tesla's growth even more so. More charging stations means that there's going to be more people who feel comfortable switching over to electric vehicles. More comfortable switching over to electric vehicles means Tesla's going to have more sales because Tesla is the biggest EV company by far. And Wedbush analyst Daniel Ives said first quarter results were a paradigm changer, and they show that the pent-up demand for Tesla's Model 3 and Model Y is just about to hit its next stage of growth. And the one thing that I found really surprising about Tesla's numbers in the first quarter, that about 185,000 vehicles delivered, and they had a record-breaking quarter despite producing zero Model S and Model X vehicles, and that was really surprising. They sold about 2,000 of them, but still having produced zero of those and still having a record quarter, that means that once they get that up and running, those factories up and running, that's going to be some big time revenue for the company because there's been a lot of pent up demand for the Model S and Model X. People have been waiting on their vehicles for a while. More people I know want to buy them, so once they do get that factory up, I think that's going to be a very, very positive boost to their numbers in terms of deliveries, revenue, and everything like that. So Joe Biden, we get that infrastructure bill. Woo, that's going to be pretty big for Tesla. Speaking of energy stocks and Joe Biden's infrastructure bill, I don't know if you guys saw the other day, Star Peak Energy Transition Corp, stock ticker symbol STPK, they had a pretty big week, pretty big couple of days. One day alone, the stock was up about 15 to 20%. Day after that, it was up again around 5 to 8% as well. So it's been doing really well. Just a couple of weeks ago, it was down at $20 a share. Now it's, hovering around the $30 per share range. And right now, this stock is still under the radar for a lot of people. A lot of major institutional investors are not invested in it yet, or people don't know about it as much. Regular everyday people as well, because it still is a SPAC and it's not like a household name. But many analysts think that it's going to become a name that a lot of people are familiar with pretty quickly, and it's not going to be under the radar for much longer. So the last couple months have been a roller coaster for STPK. It's gone from $10 a share all the way up to $4 a share, back down to 20, and now it's been up and down, which you gotta expect, especially with a SPAC. But this company has been doing extremely well. In 2020, their revenues were around $30 million stemming. In 2021, they said under contract, they already have over 4x that, around $130 million in revenue. On top of already 4xing their revenue, having that under contract for 2021, they also said that this year is going to be really big, especially with Joe Biden and the proposed infrastructure bill and everything that happened with Texas and all of the energy problems they had there in the winter and everything happening with California, the stress on the power grid. It's all lining up for STPK and STEM Inc. to have a breakout next couple of years. And I think this stock could easily go to $120 per share for a couple of different reasons. So the first one is, I don't know if you saw, but the other day, and the last couple of months, there's been a lot of talk, first of all, with Joe Biden's infrastructure bill. This is going to be spending hundreds of billions of dollars on electric vehicles, industry particularly, but also for upgrading the power grid and on energy storage and green energy initiatives. That directly benefits STPK. In addition to this, everything going on in Texas, there was a lot that happened in Texas with the cold front. People were out of power, and there were just the grid basically broke down. It couldn't support everything, and a lot of issues there. And that's where STPK, STEM Inc. come in. Their Athena AI technology solves that issue. While they can't create, more wind or more sunlight, but they do, no one can. So what they do is they store that energy, help store it, and their Athena technology helps the system determine when's the best time to use battery powered, when's the best time to use solar energy versus wind energy versus, the electric grid and the standard power grid. So it helps determine when is the best time, and it maximizes the efficiency of energy that systems are already creating. So that's going to be really essential. I think this year, especially with what happened in Texas, we're going to see a lot of different companies in Texas turn to STPK and STEM Inc. to help solve some of the issues going on. Same in California, rolling blackouts, a lot of stress on the power grid. I think that's also we're going to see a lot more people turning and a lot more companies turning to STPK, STEM Inc. very, very soon in California and Texas, especially to start. Right now, a lot of the case studies we see on STEM Inc.'s website have to do with California, but I think Texas is going to be the next market that we're going to see them really, really break into. They already are in a lot of markets. They're in Massachusetts, California, a lot of, and 30 out of 30 of the Fortune 500 companies already do business with them. They have major customers like Amazon, Walmart, things like that. But I think that we're going to see them really have a breakout year, especially with everything going on. And not to mention, one thing that people aren't talking about, which I think is really, really important, is that more electric vehicles means more stress on the power grid. More electric vehicles means more people are going to be charging. Let's say if 100,000 people have more, if 100,000 new people get electric vehicles, that means 100,000 people are going to be charging vehicles at their home overnight, or at the home, or just charging it in general somewhere. And that uses electricity. That's puts strain on the power grid. And that actually is going to put more strain, and there could be more blackouts in California and more strain on the power grid that's already old, outdated, worn out. And in order to solve that, while having electric vehicles is great, they're going to need to solve that issue, because if you add 1 million new EVs, that's going to put a lot of strain on the system. So that's where STEM Inc. and their Athena technology comes into place, and it'll help solve that. So if Joe Biden and the infrastructure bill and everything they're looking to do is going to be trying to get more charging stations, more EVs, well, that's going to have negative impacts on the power grid. And the only way to solve that is going to be with some sort of energy storage, AI technology. In my opinion, right now, that's the clear leader in that space is going to be STEM Inc. They are the clear leader, and that's where a lot of companies are going to turn to. Now on to Palantir. The other day, Palantir signed a pretty big contract. I don't know if you saw. They signed a big contract with the Department of Energy's Safety Analytics Forecasting and Evaluation Reporting Program. It was a pretty big contract, about $90 million, and a lot of people were excited about it. I did a video on it the other day. You can always check that out. All the details on it. But some analysts are saying this isn't enough, and Palantir still is overvalued. They're not too happy about the stock price. They're pretty bearish on it. I don't agree with them, but it's important to see both sides of this. And what they're saying right now is that they have some good points, but what they're saying right now is that this contract, while it was great, it was about $90 million. In my opinion, that's a lot of money, and having government contracts opens up the door to a lot more business. But they said it's like too little right now. At their valuation, what they're saying, they have a 34 times sales multiple. They need to be getting a lot of these contracts. Like, yes, it's good to have a $90 million contract. So the analyst describes how, besides in January, an $8.5 million contract with Army, like the Army Titan prototype award, that there have been no other government contract wins in Q1 of 2021. There have been contract wins and other contract signs with corporations, but not with the government. And the government makes up a pretty big portion of their revenue, while they are trying to transition their business model to having smaller companies and not just massive long-term contract signs. They're trying to switch away from doing that and allowing smaller companies do maybe shorter deals, not to put as much money up front. Well, they are trying to switch away from that. Government contracts are a pretty big deal for Palantir. It makes up a lot of their revenue, and they should be doing a lot more, according to these analysts. Justify their valuation, they say 34 times sales multiple is a really high valuation, and if you have that sort of valuation, you should be growing really, really, really rapidly, and they're not. They had a fairly quiet quarter in terms of the number of growth. They're saying the program, while it has a lot of potential, a lot of the programs they have and a lot of the deals and contracts they have signed could lead to a lot of money down the road. They could lead to extensions or like bigger contracts from the same organizations. While that is very possible, we've already seen that happen with other government organizations, renew contracts, expand the contracts. The problem is right now they need to be generating more revenue, and they're not getting enough deals signed fast enough. Like, there's nothing wrong with what they're doing, but the analyst, what he's saying is that commercial sales increased by only 4% in the December quarter. And in order to justify a 34 times sales multiple, you need to be growing pretty quickly, year over year. So we'll see what happens with Palantir. I think they have some big announcements coming up in the next couple of days. They have a demo day where they're going to be showing off their Foundry software. That'll be big. But either way, I'm still very bullish on Palantir right now. They're in the low $20 per share range. I think they have a lot of upside long term, especially with these government contracts. While they aren't, multi-hundred They're not like $200 million contracts or $300 million contracts. All of these open the door for like long-term relationships. And if companies see that you're doing business with government organizations, they're more likely to trust you, especially with a data analytics company. So I think they're in a great position right now. While they do have a pretty high valuation, looking at the next 5 years, I only see them continuing to grow and grow even faster as data analytics becomes more and more important and they get more and more integrated. One thing great about Palantir, as I don't know if you know, but Palantir, there is a very sticky company in terms like when they get a customer, that customer typically sticks around with them for a long time. It gets hard for them to leave because their different data analytic platforms get integrated into all aspects of these companies, and it's very hard for organizations and companies to leave and switch off of Palantir software once they start using it. So that's good. It sort of gets them locked in, and typically we don't see them lose customers after they've had one-time contract. Usually these contracts turn into multi-year agreements, extensions, expansions in the terms of the contracts, and that's usually pretty good sign. Now on to another clear winner. One of my favorite stocks out there. This stock, in my opinion, is going to have a record 2021. It already has 7x'd in the last 12 months since it first IPO'd, and this stock is doing extremely well. I think there's so much upside because everything is aligning for the stock to have a great year, and that is that analysts right now see the major winner in the sports betting place is going to be DraftKings, especially as New York gets closer to approving online sports betting. It's looking like they might approve sports betting in 2021 or in early 2022. We're already seeing dozens of states having legalized sports betting, and DraftKings has already been capitalizing on this. They're growing at a very fast rate, and their numbers have been extremely, extremely good. They've been growing very quickly. Their gross margin has been really good, and they're positioned as a leader in the sports betting place. They have major partnerships with UFC, with the NFL. They have, and the NFL has signed some deals with Canada and what's going on there. So DraftKings has positioned itself not only to take advantage of Canada when that market starts to open up for sports betting, but also they have the partnerships with UFC, NFL, and this opens them up to, getting introduced to new customer bases that they may not have seen with the UFC, first of all. And then the NFL, obviously, being a major partner with DraftKings, they're in a great position. We're seeing sports betting continue to get legalized, and New York being a state that is looking like it's going to legalize sports betting within the next 12 to 18 months. That is going to be a huge win for DraftKings. And within the next couple of years, we're going to see all states have legalized sports betting, and DraftKings, DraftKings and FanDuel are the two at the top. They have most of the market share, but I think we're going to continue to see DraftKings just dominate in this space. So we'll wait and see what happens. This is one of the stocks that I'm very, very bullish on. I think everything's lining up for them in terms of sports betting being legalized in more and more states. Now with New York, looking to legalize it, that's going to be a huge win for the company as well. Switching gears to GameStop. GameStop stock has been holding around, pretty consistently. We haven't seen major fluctuations in the last couple of days. We haven't seen anything like it go all the way up to $350, down to $50 again, like we saw a couple months ago. Now it's, in the mid $100 range, but a lot of analysts are saying this is only worth $10 a share. And Bank of America securities analyst Curtis Nagel, he reiterated his $10 per share rating. He's like, this company is worth $10 a share, no more. He's like, with GameStop looking to issue 3.5 million new shares at market price, while that does, give them more capital to grow the business long term, he says, bottom line is right now, GameStop is in trouble because their core business, which is gaming, selling, consoles and discs and games, that's struggling because it's all moving to digital, and it's going to be really hard for them to transition their business, pivot, and become a leader in that space. Because the problem is right now, is Microsoft is actually becoming a leader in the gaming space. They're like the Netflix of gaming, in my opinion. So GameStop is trying to become, let's say, an Amazon of gaming, where you could go to GameStop.com and buy everything you need for gaming. But the problem is now you can just download like your software for any game you want to play. You basically could just download the software directly onto your console. So that's one thing. And right now, Microsoft, in my opinion, is better positioned there because they have Game Pass, which has, like 10, I believe it's like 10 to 15 million subscribers, paying subscribers on that service, which gives them access to all different sorts of games. But right now, he's giving GameStop a price target of around $10 a share. My opinion, I don't agree with this. While the company is, even the executives at GameStop, they say it's overvalued. They say the valuation right now is not tied to reality, not tied to what the financials are of the company. My opinion, I don't see it going to $10 a share anytime soon because, first of all, the Wall Street Bets community is around 10 million people, and everyone who's part of that community still believes in GameStop and doesn't want to leave the stock. So for that reason alone, if people aren't selling their shares, I don't see the stock price going down. Obviously, it might trend downward slowly, but I don't see it reaching $10 a share because now with this additional capital that they'll be able to raise, they're going to be able to grow the business and potentially pivot. It's not going to be easy, but they have a great management team now. They have Cohen, who is the founder of Chewy, who has been taking a bigger position in GameStop recently. They've hired a lot of new executives from Amazon, Walmart, replaced their CFO, Chief Growth Officer, Chief Technology Officer. They've made massive changes. And in my opinion, I think right now they, while $10 a share, in my opinion, is ridiculous. I don't think they're going to $10 a share. I do think right now their valuation isn't tied to reality. But I think with the changes they're making, if we see positive news come out, we see sales start to increase, we see them really start to transition to being a more digital company, I think we definitely could see the stock price do well. I think we could see it do fairly well. In addition to this one analyst from Bank of America Securities, Telsey Advisor Group analyst Joseph Feldman, he gave it a $30 price target. He says the company has yet to show financial success in an industry that's rapidly shifting digital, and really that's the big issue. So whether you're looking at this long-term, short-term, the big issue is short-term there could be major fluctuations. This could easily go to $300 a share in a week if there's some positive news on GameStop, but could also go down to $50 a share. Like, it could really fluctuate just depending on some positive news or negative news coming out. But if you're looking at this long-term, the big challenge is going to be transitioning from like a retailer to a solely digital business because their retail strategy is no longer going to work. They need to be a digital company. They need to be like the Amazon of gaming, which is possible. And they have the right team in place to do it. So we'll have to wait and see what happens here. And now on to Nikola. Nikola has been struggling ever since that short seller report, rightfully so. But now they're losing another key executive who has been with the company since 2018. He was basically one of the lead people in their fuel cell development in hydrogen fuel cells. Now he's leaving. Essentially what he said is that he left Nikola with the purpose of starting his own new company where he'll be the CEO. And if you look on the guy's LinkedIn profile, he's now listed as a CEO of Zev Station, a startup that is working on renewable energy powered electric charging and hydrogen fueling station. But this is a pretty big deal that one of the head people, like the head of the hydrogen fuel cell development on the Nikola team, is leaving the company at this moment. And this was the executive vice president of technology, hydrogen, and fuel cells. He left the company on April 1st, and this is a big deal because Nikola, this is a time when they need to be really proving themselves, getting a lot of stations developed, and getting their first vehicles rolled off the line. Otherwise, people are going to lose all trust in this company. Already, there's a lot of people don't trust this company at all, and I'm not too crazy about it myself. But Nikola, their first hydrogen-powered truck is due to go into production in 2023 at their factory in Arizona. And on top of this, the company says that they're already starting to be working on a network of hydrogen fuel cell stations, with the aim of building several hundred over the next decade, and installation of the first of these is expected to start this quarter. So with installation just expecting to start within the next 6 months, even in this quarter, it's very important that they had this person in place. Obviously, in my opinion, the stigma around Nikola Motors right now is just not there. People are not too crazy about the company, and that's why we've been seeing all these executives leave, because they don't want to be tied to the company anymore, in my opinion. I mean, obviously, this guy wants to go start off his own company, do his own thing, but he was already leading the team at Nikola in the exact space where he's building his new company. So we'll see what happens here. Either way, things are not really looking great for Nikola right now. I'm probably not going to change my mind on this stock. I'm not too crazy about it. Only thing that would change my mind is when we start actually seeing vehicles delivered, stations installed, like hydrogen fuel cell stations installed. Until we start seeing stations installed and vehicles delivered, this is just an idea. And a lot of other companies are just around the idea of what they could do in the future. But with Nikola, they've lied to investors already, and things have happened that have lost a lot of trust. So if you're investing on a vision of the future, it relies a lot on trust. And if the company has lied, that's not a good sign. So seeing more executives leave, their founder, Trevor Milton, has been selling millions of shares pretty consistently over the last couple of months. Things just aren't looking great right now. Only thing that will be able to change this around, in my opinion, is if they start to get more and more positive news come out in terms of deliveries. Maybe they see a shorter timeline, or installations, those get pushed sooner. So we'll see what happens there. But that's just going on. A lot of different stories, topics to cover in today's show. If you're new here, you made this far, make sure to join us every single day, 8:30 a.m. Eastern time. New episode where we talk about the stock market, a lot of different companies that we cover. So I hope you guys enjoyed today's video. If you did, please be sure to like it down below. Also, don't forget you can get 4 free stocks when you download the Webull investing app. I'll put the link down below to that as well. Hope you enjoyed, and I'll see you guys in the next episode.